What we've learned this week is what we've known all along, and that is the market's sway according to tariff talk. We saw that rally based on that report saying that his stance will be softer. Here we are. Auto tariffs are looming. And any moment, and we saw the markets go lower. So what do we do? I
think you're going to have to we've talked about it, you're going to have to be prepared for these types of, ebbs and flows in terms of the market, in terms of the rhetoric, and we're on the other side of it now. I think in terms of the broader market, 58.25 in the S&P was the level I think collectively we thought we could trade to. We got close. That was a 50% retracement of the all-time high in this recent low. It all makes sense, and I think this sell-off is just a continuation of what's been in place since early January.
Yeah. What do you think?
Well, I think we failed at the 200-day in the NASDAQ and in the S&P, and the question is the Trump put really at a 5,500 strike? Because that's what we got. It's a day. We also got comments from the Fed just kind of implying that maybe tariff impact isn't just temporary. And I think that would be more a reference to the inflationary side. But we've heard auto executives, for weeks now, and certainly in the last week. And there was apparently a Zoom that went on or a video conference of some kind. And the point was that we don't necessarily need this. The White House is saying that this is aimed at inspiring and spurring domestic growth. And yet when you're talking about the numbers we're getting through on what this means in terms of the kick higher in auto prices, and there's numbers out, and we don't really know where they are because we don't really know what the tariffs are yet. But the reality is that it's something that the industry isn't necessarily rooting for, even though imports, which are finished good cars, not auto parts, et cetera, are something that conceivably they could be targeting.
Well, it's coming at a bad time, right, for the auto industry, if you just think about it, right? And, GM, Ford, and, rest of Detroit, and then you go over to Tesla. You probably thought that I was going to avoid that. I mean, this is actually really bad for Tesla. When you think about the kind of price war that is going on right here, if you start having some disruption in the supply chain of the parts that are coming in here, you think about how do you make that up? They're already doing like 0% financing and the like. Then you get the reciprocal tariffs, and you're going to China and you're saying to yourself, I'm competing right now with BYD. I'm competing with Xiaomi. This new car that they've introduced is outselling Tesla Model 3 right now. So, I think there's a lot of adverse effects that you could see on the auto industry, and I think it's actually probably worse off for Tesla.
I think you have to trade through all of this. You almost have to not listen to it, because there's a lot of stuff that is, I would say, algorithmic trading or tape reading trading. So if you think about it, didn't they have to deal with mandates, EV mandates, emissions? How much was that? 3,000, 8,000 per car that they had to add? So this is probably the equivalent of 3,000 to 5,000 in tariffs. I would say avoid them because of recession, not avoid them because of tariffs. If the market's going to slow down, you have to avoid buying all these luxury items because the interest rates are too high.
Isn't recession, though, a function of tariffs? Or you think?
No, I think it could facilitate one. It could push us into one. Recessions are cyclical. They're natural, normal. I think we're overdue for one. I don't think this one will push us into one. There's none in place. So if you think about it, let's see what they are first before we react to them. So the guy's point where he kicked it off. It's got to be like a NASCAR. You drive to the accident. You don't try to avoid the accident, right? Because it's not there when you get there. So if we're investing, trying to avoid a tariff, and it never comes to play, then you've actually chased your own tail in this market.
That was a scene in Days of Thunder when Cole Trickle, he had to drive right at the accident. And remember, Robert Duvall said, you're going to make it through, drive through it?
You say you remember as if I watched that.
Well, it's funny because Tom Cruise is a big fan of the show.
I understand. But
this is more of a rubbing is racing situation, right? Because we don't really know, to your point, where this is going to end. And I actually think you have to take this at its face value right now. My view going into this stuff is that they were going to pull them. They just weren't going to do it. They were going to use it as a negotiating tactic, which, they did the first time around. So right now, if you do this, I mean, it's just really coming at a time where a lot of the data we're seeing from a consumer standpoint is not particularly great. And I think that, to your point, there's a lot of discretionary sort of thought process around buying a new car.
And what Tim said, the 200-day moving average is 57, 56. We were below it for 11 days. We were below it for 9 days back in 2023. We popped above it. We failed. We didn't do that back in 2023. We stayed above it, and we ramped right from there pretty much into year end. So if you have to look at the technicals, 57, 56 in the S&P cash is what we need to reclaim in order for the rally to be back on.